You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Rick Ackerman, editor of the newsletter Rick's Picks. His website is rickackerman.com. He's speaking to us from Colorado. Welcome to the show, Rick.
Thanks for having me on, Jim.
I've noticed oil prices have dipped over the last 4 or 5 days. Is this going to be a continuing trend considering we're going into the driving season?
Well, it's always either driving season or refining season. You know, the prices are kind of sticky coming down, but it doesn't take long for them, for the pump price to go from, well, here in Colorado, close to $2 on premium to something like $2.50 in a couple of weeks. But I don't know. It's hard to get excited over crude oil prices right now, and you get a sense that supply and demand is very much against the bulls still.
What about alternative energy sources? Are they catching up to the affordability of crude?
Well, not if you're using Germany as the example. You know, they've spent so much money on wind power, and of course they're even more committed than ever to what you would call renewable energy sources now that they've sworn off nuclear. They're basically phasing out nuclear in the early 2020s, and it's just expensive, and it's very hard to get a sense of what it costs to create wind-generated power because of the very complicated subsidies that go into it. But you get the impression that the fossil fuel, which there's still plenty of, is the cheapest way to generate power.
How do you convince producers under public pressure to switch?
Here in Boulder, they do it by essentially strong-arming the public utility. You know, they've been kind of batting it around for the last 3 years. Boulder it's been threatening to take over all power generation with the municipal station. And, of course, the argument pivots on whether Boulder can operate as efficiently as a utility company, or whether it's simply letting politics dictate the choice. So I think this is probably playing out in other cities around the country, but Boulder is perhaps a little more committed than most to renewable sources of energy.
Now, considering Colorado is oil territory, is that a hard switch?
Not really, because, we export a lot of energy, and it's not as though just simply because so much of it is refined in our own backyard, so to speak, that it doesn't seem to affect the prices that much. And in fact, if you were a payer of monthly utility bills, as we all are, you would think that the collapse in natural gas prices might have had an impact on our monthly bills, but they haven't. You know, seems like it costs me more money to heat my house every winter, regardless of what the price of natural gas is doing.
The British pound is at its lowest point against the euro in about 9 or 10 years. Is that going to continue for a while we still have this referendum about leaving the European Union hanging over our heads?
I can't see where that's not a plus, really. You know, the term is Brexit, British exit from the EU, and it seems like that would be a net positive for the currency. Another positive that's working all the time is that London is a financial center. You know, the British have learned very well how to make money the newfangled way, namely with financial assets. And of course, a lot of the action shifted to the London markets after the U.S. Collapse of 2007, 2008, mainly because I guess you could say they had to recollateralize the big enchilada. You know, we grew a bubble out of mortgage debt here, but the changes in mortgage rules were such that the players, in other words, those who have grown a $quadrillion derivatives edifice, needed some other form of assets to hawk up to their ear balls. So in London, this is something that got written about extensively on Zero Hedge. You had the phenomenon of rehypothecation, where you can take, just for example, a worthless brokerage account, that's defunct, and you can leverage it 10 times downstream. So the net result was that we've had in this last cycle, since the recovery from the 2007-8 crash, we've had the leveraging has taken place mainly in the energy patch. And of course, that's why lower crude oil prices are a threat to the global financial order.
How long can Saudi Arabia keep pumping out oil at this low price?
Well, no one has said anything about Saudi Arabia running out. Their ability to pump seems more or less unlimited. And at the margin, it sure is made simpler by the fact that the largest energy consumer at the margin, China, is in a wicked slowdown. So the remaining producers, the ones such as Iran and Russia, who would most desperately like to see energy prices up, and I guess you could include Brazil in that group, they can literally go pound sand, because again, the supply-demand picture is very much tilted toward buyers right now.
How long can the oil producers hold on in North America?
Well, there's just a story in the Journal yesterday about how they've all kind of slowed the pace of exploration, but that's kind of a last-ditch effort to curtail supply. And of course, it sets up a vulnerability somewhere down the road, to the extent that these oil producers and frackers are not doing much in the way of exploration. They are curtailing supplies down the road. In the case of the majors, Exxon, I think that they were at something like 70% of replacement. Ordinarily they sell X amount of crude, and they do explorations that bring approximately X amount of crude on stream. And in this case, they've essentially depleted inventories and to the tune of about 30%. So that's a huge drawdown, and there's no question it will have consequences going forward. But for the time being, the world is awash in energy.
The International Energy Agency said that there had been an historic withdrawal of investment in crude oil, and they say that could lead to a future shortage.
Well, it could, but again, it's very difficult to speculate on what the supply-demand picture might look like in 5 years. If China turns out to be an outright bust, that could essentially remove a huge piece of demand for the next decade. So it's on the other hand, if you think the global economy is going to come roaring back, that would be bullish for oil prices. But I don't have the imagination to see a rip-roaring global economy myself.
China at one point was selling 60,000 cars a day. Are they still snapping up cars like that?
Well, things have cooled in China, and it's at the consumption level. I would guess they're probably selling a lot fewer cars, but you see at the corporate level, some of these companies that are moving on. Well, for one, the Starwood hotel chain. We've got Marriott bidding against a large Chinese, I think it's an insurance company, and at the corporate level, you see that there's some desperation about getting money out of China and into either U.S. or global assets owned by U.S. multinationals or some of the other multinationals. And up to a point, you'd think, well, the Chinese were a lot more discreet than the Japanese were when Japan had its last hurrah in the late 1980s. You may recall that they were buying Impressionist paintings, Pebble Beach, Rockefeller Center, pretty much anything that had a little bit of cachet. The Chinese, on the other hand, for years were buying, tin mines and Iranian natural gas production. They were buying essentially energy assets and a bunch of other things that you think would put them in good stead for the next 25 years. But you can see that they've come down a bit from that perch, and now some of the not too cautious about what it is they're buying. So and they pay, of course, the highest sum ever paid for a single hotel when they bought the Waldorf Astoria for $2 billion. So it suggests that they may have lost control of the value idea.
Well, I know one area that they are putting a lot of money in is real estate in places like Vancouver, and the high-end luxury houses, bidding them up to unbelievable prices.
Yeah, you mentioned that. I mean, you live in Vancouver, and so you're sort of in the midst of all that nuttiness, and certainly all up and down the West Coast, there is enormous buying by cash-paying Chinese buyers, and of course, it's very hard to compete with that. If you should want to live in Vancouver and work there, it's very difficult to find something like a starter home. You see a home going to market, and you're living it. I've only been reading about it. As soon as the for sale sign goes up, they've got 12 cash buyers. So it's too bad, really, because certainly that's going to impact the economy in a negative way when you get a skew in investment toward housing stock rather than toward basic manufacturing and the economy and greater good of Vancouver.
I've been told that the Chinese real estate investors don't care if the property falls 20% in value because of the bubble, because at least they got their money out of China.
Yeah, and that's all right, I think, at a micro level, but at the macro level, it does have an impact. You could have said the same thing about Latin American buyers down in South Florida going into the last boom. I would visit a friend of mine who lived in various high-rises along Miami Beach, and I was always struck by the fact that she had each of these buildings all to herself. I remember one place, there was an entire ground floor beautiful apartment, supposedly owned on spec by Shaq O'Neal, and there were so many see-throughs that you would hear, well, the buyers are off somewhere, they don't really care what happens to the property, but of course they only have the luxury of not caring when the economy's going great guns. And of course, anything they're far from it in Brazil right now, and probably wishing they had the money back. Maybe these Chinese cash buyers are going to be wishing the same thing.
Well, Brazil, of course, has to host the Olympics, and they're in horrible financial shape. I wonder just how successful the games will be, or is this going to be a case of course, the government will try to make the games look successful, but you wouldn't want to be one of the people living next to it.
Well, it seems like the Olympics is more of a headache than it's worth. Everybody, every country wants to host the Olympics just for the prestige of it, but it hasn't turned out to be much in the way of a money-making operation. And in fact, it's a big money loser. And Brazil is stuck with it now.
We'll have more with Rick Ackerman right after the break.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Bird Dog and the Vintage Electric Band coming to Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Rick Ackerman. Rick, if crude prices aren't going to do well for the next little while, is there an area that excites you for investment?
Well, very little looks exciting now. I haven't changed my mind about the big picture. I like being in long-term treasuries or paper that goes 40 years out because you're enormously leveraged to relatively small decreases in interest rates now. And, of course, you're not buying 10-year notes, 30-year bonds, some of these 40-year California school bonds and things like that for the yield. you're buying it for the capital gains potential. And my forecast for the long bond, 30-year, is still 1.64%. So we've got a lot of room to move. And on the price side, that would produce, if it were to occur over the next 18 months, the capital gains would be on the order of 25% plus. So I like the looks of the bond charts. You know, we've been in kind of the thick of a consolidation for a while, but the correction hasn't been much relative to the larger long-term trend in T-bonds. So I like bonds, and I still like gold defensively. I'm a bit of a fence straddler in gold because I've used a bearish target down around 815, well below the 1,050 lows reached at the recent bottom. But I like gold defensively, and I think like T-bonds, these weak periods in gold look more like consolidation to me than distribution.
Do you think the Fed will have the guts or the gumption to raise interest rates again this year?
Well, that's an oxymoron. When you talk about Fed and guts, you know, those two words don't comport that well. You know, I never bought into this interest rate thing or the tightening. If you open your mail each day, you'll see that however much they've tightened, it hasn't stopped the banks from flooding customers like me with offers to lend me money at 0% for the next 18 months. So the banks are eager to do business, and I think the idea of the Fed actually tightening, I never thought that was possible. And over a period of years, I would hypothetically pose the question, when will the Fed raise interest rates? Answer, never. And yes, I had a pretty good run going there for 7 or 8 years while they only threatened to tighten. They finally did, but of course it was with a very timid 25 basis point ratcheting and administered rates. It has no practical consequence simply because you know, they can't even affect the short-term rates because the banks have no trouble at all borrowing from any number of sources to get around whatever the federal funds rate is. So it's really hard for the Fed to tighten when money from so many other sources is so loose. So I think it's just a lot of bull. You know, it's just a bluff. But the danger is that the Fed will start believing its own story, that it's tightening because, well, you know, the U.S. quote-unquote recovery can finally stand on its own.
The U.S. dollar has had a huge charge over the last few years. Is that going to continue?
Yeah, I'm very bullish on the dollar. The dollar index is a bit under 100 right now, but I think it's eventually going to find its way to 120. It's not an easy play, you know, just long dollar this or dollar that, simply because the strengthening of the dollar would be akin to hearing the trumpet sound from on high, that Armageddon is close, because the very strong dollar would be of a piece with a deflationary bust globally. So when I talk about the strong dollar, it's not part of a normal process that the dollar will simply continue to wax through accretion. I see it more as I see a very strong dollar as being calamitous, and again, it's going to be accompanied by a tightening of deflation, which we've talked about before. Deflation is best understood by its chief symptom, namely an increase in the real burden of debt. So that's the best way to understand it, rather than to get all screwed up like the monetarists and think of inflation and deflation as functions of how much money is in the system.
Well, the Canadian government just brought out its new budget with a $30 billion deficit. During the election last year, they said we'll run a $10 billion deficit. So they've tripled their negative spending plans. Is that something governments have no choice, or can they keep their costs down?
Well, there's a dynamic problem there. You know, it's one thing to loosen, but if you were to measure the amount of loosening versus the amount of GDP growth that each new essentially borrowed dollar creates at the margin, you would discover that it's taking more and more quote-unquote stimulus to create that dollar's worth of economic growth. So, you know, coming out of World War II, we had a very fleeting experience with each new dollar of debt essentially begetting us a dollar plus worth of economic growth. But I wrote on this subject for Barron's quite some time ago, and at the time, it looked like the $2.40 that we were spending to generate a dollar's worth of growth was about as stretched as things could get. But since then, the amount required to generate that dollar's worth of growth at the margin has gone literally off the charts. Nobody even knows what it is. No one could tell you how much stimulus has to be shot globally in order to get the real economy to grow by even 1 percentage point. And of course, if you were to go to Europe and look at those numbers there, you'd see that no matter what the stimulus, they get no growth at all. So that's the problem, really, with the stimulus game.
Rick, anything else you wanted to add this week?
Just to touch on that point again about what deflation is. It is it's observable mainly by its chief symptom, which is an increase in the real burden of debt. And I think the place to watch right now is the energy patch, because as I mentioned, the whole collateral bubble that collapsed in 2007-8 that was based on housing has been essentially replaced by energy-based collateral, and that's why there's all this urgency about getting the price of oil up, and why the U.S. stock market rallies whenever crude oil is rallying. The world is desperate for a little bit of inflation, especially in that class of assets that has been hawked so heavily in the last cycle. So just keep your eye on the energy patch, Jim.
Rick, thanks for chatting with us.
Thanks for inviting me on.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks. His website is rickackerman.com. He's speaking to us from Colorado. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Comments or questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.